entity that is being audited. The entity that is being audited provides the auditor in their process of performing the audit duty.
I don't think I totally agree, but thank you for your contributions. Thank you. Jimoke provided on the chat box that audit evidence is information collected by an auditor to ascertain the accuracy and compliance of the company's financial statement. Well, yeah, maybe a little bit idea, but I need more contributions that are more convincing. Adekoye says, audit evidence are those materials gathered or items used in forming an opinion, in forming audit opinion. Maybe technically yes, but not totally hit the nail on its head. Okay, remember in our very first class when we talked about assurance services, we did affirm that there are quite a number of assurance services, basically grouped into two, those that are of limited assurance and those that are of reasonable assurance, right? External auditing was grouped then as one of the examples under reasonable assurance. And we did clear it then that the primary intent of external auditing is to express an opinion. It is the expectation that auditors don't just jump to conclusions. Basis on which the independent or unbiased opinion are reached should be corroborated with substantive evidences. So what we are looking at today are those things that we actually, or that could actually qualify as audit evidence, which must have been gathered by the auditor as part of their, as confirmations of the findings they made in the course of their audit exercise. So that is to give us a kind of basic underground on the foundation of what we are looking at today. We'll be considering the following topics or subtopics. Audit evidence, what actually validates or emphasize the need for auditors to gathering audit evidence. To what extent will this be relevant? How long should the evidences be maintained? Will there be any future use for these evidences? Where there are, in what form could these evidences be relevant? So there are quite a number of standards that speak to audit evidence. So in the course of this, we'll be looking at what audit evidence actually means, as far as it's a 500, 501, 510, 520, 530, 540, 550, 560, 570, 580, 600, 610, and 620 are concerned. All of these standards, in one way or the other, make references to audit evidences. And that's why I said today's class may be very lengthy. We probably may not be able to wrap it all up today, but wherever we stop today, we could then wrap it up next week. So concept of audit evidence will be considered. What are the various types of audit evidences? Qualities of audit evidence, of a good audit evidence. Techniques for gathering audit evidence will be considered. Audit sampling is also very key. How do we get our sample? out of which the evidences are then extracted. Meaning of sample, types of sampling, procedure of sampling, evaluations of sample results. We want to be sure that the sample that have been chosen is a full or qualifies as a full representation of the entire population. Specific audit procedures for various audit captions will be considered. What are the specific audit procedures for auditing revenue, cost of sales, expenses, payroll, fixed assets, and others. Then we look at internal control testing. Before in the course of our audit process, we may want to assess the level of controls. How effective and efficient is the controls imputed by or introduced by the management? We'll be looking at that. We'll also consider internal audit considerations, audit working paper, content of the working paper, forms of audit work paper. Some are permanent and some are recurrent or current. What are those things that qualifies as permanent audit work paper, and what are those that are of recurrent in nature? Then we look at the concept of confidentiality again, custody and ownership of work paper. How long after the field audit work is it statutorily expected that audit work paper must have been completed? How long should statutorily audit work paper be kept by the auditor? Who actually owns the audit work paper? And under what circumstance will the auditor be expected to make this available for verification? So these are all the things we'll be looking at today. As much as possible, because of the lengthy nature of the course, I will want the class to be very participatory. So from time to time, I may call on one or two persons to helping us maybe either read through or share their opinions about what the presentations might be talking about. As much as possible, I will expect that all through this class, you'll be very cooperating and contributive. So ISA 500 talks about audit evidences, right? So in my words, I put this as audit evidence is information used by the auditor in arriving at the conclusions on which the audit opinion is based. What does this mean? Who can explain this to us?
Okay. Okay, I think this just means that every information according to what the statement says. Information including both directly generated by the auditor, information from the company, that's from the client.
Sorry, can you speak a little bit louder to your mouthpiece?
Okay.
Your voice is very faint.
What about now?
A little bit more. I'm so sorry. I'm struggling to hear you.
Okay, what about now?
Okay, I think it's better now.
Okay. So I feel like audit evidence, according is the information used by the auditor in arriving at the conclusion, just explains that they are all the information used by the auditor, either the ones that were directly collected by the auditor, the ones from the entity, the ones from third party, every information the auditor used in arriving at the conclusion, that is the opinion that the auditor ends up forming at the end of the whole audit exercise.
Okay, so thank you. Remember, auditors are saddled with the responsibility of expressing their opinion on financial statement prepared by the management. So this opinion can either be qualified opinion or unqualified opinion. If you are giving an unqualified opinion, it is believed that there are assertions that the management has made, and it is also expected that you will have verified those assertions and find them to be true, or where they are not true, you find them not to be true. So what audit evidence is speaking to is just saying that if you say all is well, what are the evidence that you have affirmed and you have confirmed to be in the right perspective? If you say there is threats to the going concerns of the company, what are those indicators that have been identified? Are those indicators verifiable? To what extent have you extracted this? And should this be verified by another person? What is the likelihood that the same opinion that you have arrived at would also be will also be made by those people given the same circumstance and scenario? So audit evidences is just saying that, speaking to the fact that auditors in arriving their opinion should extract corroborative evidences that can be verifiable by any other parties other than the auditors. And this is very crucial for us to have this documentation, because sometimes later on, the opinion that we have reached may be questioned, or there could be instances where the auditors could be called upon to speak to certain issues in the courts, right? And by then, it would not be fair if you are just saying there are no evidences for all the submissions or opinion that you have reached. So this includes information in the accounting records underlying the financial statements and that obtained from other sources. So one of those things, audit evidences comes in various forms, or could come in various forms. It could be in hard copy, it could be in voice notes, it could be in third-party confirmations, it could be in bank statements that you have verified, it could be in written representations, it could be in every form or any form. So auditors are in a better state to deciding what is a suitable evidences that they want as a confirmation to the assertion they are expressing opinion on. The auditors shall consider the relevance and the reliability of the information to be used as audit evidence. So in terms of relevance, to what extent has those evidences been able to speak into the assertions at hand? And to what extent can it be reliable? So in terms of reliability, you are looking at how credible is the source of this information. If the information is coming from third parties, how can you speak? To what extent can you certify the objectiveness of those third parties? So you need to assess that what you have gathered as evidence is actually related to the assertions at hand. And those information too are also from credible sources. When you get evidences from parties other than that of the auditee, it is presumed that it could likely be more relevant as opposed to where the client is giving you those confirmation that could have been gotten from an external party. So when using the work of a management expert, because there are other instances whereby you need to use the work of other experts. The auditors shall evaluate the competence, capability, and the objectivity of the expert. So if, say, for example, in the course of my audit work, we need to do fair valuations. I, as the auditor, may not be able to doing the valuation, particularly where the item or asset being valued requires special skills that auditor may not in all its situations have. Probably we want to value the building and we need the service of an exit valuer. So in terms of competence, I will have to look at the track record of the entity who is to do the valuation, the exit valuer. You also have to do consider how well have they been able to doing it. Are they certified by any credible professional institutions or not? Do they have the required or requisite license to doing that which they are called upon to do it? So the volume or the extent of their professionalism, the thoroughness of their work, the affiliations to the relevant professional bodies, the track record of what they have done in the past will speak volume to how well or how competent they could be, how capable they could be, and how objective their opinion of the expert could likely be. Then the second one, we are also expected to obtain an understanding of the work of the experts. Whatsoever the experts could have done in terms of their confirmations or valuations of whatsoever thing relating or required of the third party confirmation required, you definitely will have to make or request the third party or the expert to giving you an understanding of what the work process should be and what are they expected to do to arriving at the agreed opinion. Then the third one is evaluates the appropriateness of the expert work as audit evidences for the relevant assertions. Management generally have made several assertions in the financial statements. There are declarations and presentations made in the financial statements relating to fixed assets, relating to current assets, relating to liabilities in general, relating to equities, relating to inventories, relating to incomes and expenses. So if it was reported in the financials that a total expense of say XYZ million has been incurred in a particular period, so the relevance or the appropriateness of the audit evidence required in that instances will be, are those expenses actually relevant? Are they necessarily to be incurred? Are they wholly incurred? Are they reasonably incurred? Then do we have third-party confirmations in terms of receipt invoices, approval to actually incurring those expenses? Were they in line with the company's budgeted provisions for that line of activity? Did they exceed the budget sums, or were they actually incurred favorably? So all of those will inform what will be appropriate for each assertions to be verified or not. So I need a volunteer to help us through with this. Still on ISA 500, audit evidences. Who is volunteering?
Okay.
Any volunteer? Esther,
Yes,
will you
sir.
help?
Oh, yes, sir. ISA 500. When using information produced by the entity, the auditor shall evaluate whether the information is sufficiently reliable for the auditor's purposes, including as necessary in the circumstances. Obtaining audit evidence about the accuracy and completeness of the information. And 2, evaluating whether the information is sufficiently precise and detailed for the auditor's purposes. Did you hear me, sir?
Yeah, I do. So
Okay.
this for that supports what I earlier explained. In the course of our audit work, there are verifications of processes. There are verifications of processes that is beyond the scope of our work. And we need confirmations of opinions of other experts. So should you want to use the work of an expert, these are some of the affirmations that you need to confirm before you can then conclude that, oh, those expert work that they want to use as audit evidence are not only relevant, but also sufficient. If the audit evidences obtained from one source is inconsistent with that obtained from other sources, or the auditor has doubt over the reliability of the information, the auditor shall determine what modifications or additions to the audit procedure are necessary to resolving the matter. Okay, so let's say, for example, you are auditing a client, and in the financials, they said there are accounts maintained with two banks, say First Bank and Zenith Bank. And in that of the First Bank, they affirmed that, oh, the bank balance is say 4M, and Zenith Bank is say 20M. You did a bank circularization, right? And the bank responded, but the confirmation received from the bank resulted into a different values other than what the client had earlier confirmed to you. And they even confirmed that other than that same bank, I mean, that same account balances, there are other investment securities or financial assets that the client has with the bank, right? You will not just conclude, you are expected not to just conclude that what the bank has given to you is more accurate than that which the client has provided. You need to determine what other audit procedure do I need to conduct to be sure that what the bank has confirmed to you actually relates to the period of the audit, actually relates to the appropriate client, actually relates to the instances that is being considered. If all that is being confirmed and the opinion of the third party hearing the bank is more accurate than what the bank or what the client has given to you, you then have to decide whether there will be need to reform or modify your earlier opinion, or you make certain appropriate recommendation to redressing the concern. What will warrant you modifying an opinion is a function of how material is the inconsistency that you have that has come into your awareness, and how willing is the management to taking into correction and rewrite the wrongs, right? And you also have to assess to what extent will or could that material inconsistency affect the would-be end users of the financial report or statement. So all of these will accumulate together to make the auditor make a better informed opinion, whether a modified or unmodified. I believe that is well understood. Please, do you have any question in that note? If you have any question, indicate, but if not, just indicate that we go on. All right. So for us to understand better what we need to know in or what ISA 500 has provided in terms of what an audit evidence is, in what forms it could take, what are the validations that the auditor needs to make before you adopt those evidence as being substantive, and appropriate? What are the sources or places that we could get evidences from, particularly as relating to expert opinion? For all and more information about that, you will need to make reference to ISA 500. You will agree with me that time will not permit us to be able to speak to volume all that the standard intended. But of course, as part of the materials for today's class, we will share each of these standards, and I would expect that you peruse them. Wherever you have more concern, you can engage us further. So let's look at the next standard. It's a 501. Still on audit evidences, but in specific consideration to some selected items. Under this standard, the auditor is to obtain sufficient appropriate audit evidence regarding the following. One, existence and conditions of inventory. So when you are conducting audit procedure on an inventory, you need to confirm that the closing balance or the reported sum for the audit for the inventory, does it actually exist? Do we actually have that inventory at all? So for you to confirm whether we have it at all, what are the evidences of prior balance before the reporting period? What are the evidences of purchase requisition requests made? What are the evidences of approval to purchasing the inventory? What are the evidences of supplies of those inventory made? What are the evidences of payments made to whoever that make the supplies? And what are the evidences of issue of this inventory to sales or to productions? So you need to see and put on an appropriate audit procedure around all of this process to be sure that disclosures and presentation made with respect to the inventory is actually a representation of what is fair. Then the second one is the completeness. Completeness of litigations and claim involving the entity. So ISA 501 also speak to instances whereby you want to affirm whether there are or not litigations against the auditee or not. So in that instances, what are the provisions the standard intended? How do we get those confirmations or those completion processes? What are the audit procedures that we need to carry out for us to be able to reach a better, to gather a more representative audit evidences? Then the third one is presentation and disclosures of segment information in accordance with the applicable financial reporting framework. So these are some of the cogent issues that ISA 501 audit evidence specific consideration to selected items speak to. We will then take them in turn and talk about them in volume. A volunteer, please. Okay, Olajumoke, you have the floor.
Okay, good evening, sir. So inventory. If the inventory is material to the financial statement, the auditor shall obtain sufficient appropriate audit evidence regarding the existence and condition of inventory by 1, attending physical inventory counting unless impracticable, 2, to evaluate management's instructions and procedures for recording and controlling the results of the entity's fiscal inventory accounting. 2, observe the performance of management accounts procedures. 3, inspect the inventory. And 4, perform test counts. And 5, performing audit procedures over the entity's final inventory records to determine whether they accurately reflect actual inventory count results.
All right, thank you.
Okay.
So making this as practical as possible, I want to confirm if anyone works in an audit firm here, please indicate. If anyone works in an audit firm here and you have done an audit process around inventory before, please indicate. We want to make this as practicable as possible. Do we have Raymond here? What about Adeni? Is Grace here? Hello, Grace.
Hello, Mr. Akunle.
Okay, good to have you. Good evening, ma'am.
Good evening.
Okay, I just want to put you on the spot.
I'm in a party.
What do you say?
I'm in a party.
Oh, okay. You can mute your mic. Do we have any volunteer who is willing to speaking with us on audit process around inventory? Any volunteer who works in an audit firm?
Yeah, sir. Good evening, sir.
Yeah, Victor, good evening. All right, so my question is, I don't know whether you've done any audit process around inventory before now.
Oh.
I don't know whether you've done any audit process around inventory before now.
Yes, sir.
Okay, can you explain to the house what are the pre-audit activities that you did and the field activities you did on inventory?
So, what first thing that we do in our audit, first, when we get to the company, we first do what we call number counting of items in the warehouse. What we do, we go to the warehouse, we count all the inventory inside the warehouse. That is the item one by one. We take record. When we take records, we went back to the second phase when data had been input, either the accountants or the manager of the company. Because the company was having branch by branch, but we went from the head office to all the branches across the state. So after that, we confirm the prices of all the items from the list from the directors. Let me just say the board of director list that they send direct to the audit. We confirm the item price. We went back to the accountant account. We check the inflow. That is the inflow, all the items that has been bought from January to December in the company. Now we talk about the outflow. That the one that they sells, of course, the company deal. Let me say they give item to civil servants while they deduct from their salary every month. So now, anyone that they supply to the civil servants, they will be deducting every month from their monthly salary. So they will indicate their supply. Anyone they supply to the civil servant will be supply. They did supply and they did a lot of car sales, that day-to-day activity that they sales their business also. So now, after that, we check the customer that they supply, which are the customer that are partaking with the company, that the civil servants. Secondly, we check the one that they sell out, that is called the daily sales that they make to the company. And there's something that they call in the company, we call it down charge. Anytime the items are being supplied to the civil servant, now the civil servant will pay from, let me say, from 1,500 to 6,500. There's down charge. It depends on the amount or the price that the quantity carry. So now you're going to check the amount deposit to the company account, which is the down charge. We do head to count the one that they supply to the civil servant, which they have been deducting every month from the civil servant, we check the one that they make car sales every day activities to reconcile with everything that we call and the petty cash book also, sir.
All right, thank you, Victor. The procedure, the audit procedure around inventory from company from firm to firm and on engagement to engagement differs, right? But holistically, you will remember in one of our previous classes when we talked about audit planning. It is expected that you must have completed the client onboarding process. The client will have sent you some extracts of their financials, the trial balance, the management accounts. You will have had also the prior year accounts. Using the prior year accounts and the current year information, you will be able to reach in a consensus on what your materiality threshold is or should be. You will have also ascertained what your performance materially should be and clearly trivial. Based on that, you ring through the trial balance and identify items of the trial balance that are above your materiality threshold or your performance materiality or clearly trivial materiality. If inventory value is among those items that are spotted as being material, then you will need to develop a clear and a very comprehensive audit process for that assertion that has been made. Now, looking at the assertion, you know, at the end of the year or before the end of the year, the cash count, audit inventory count will have taken place as at the last day of the year. If it is an engagement that you have had before the year end, it is expected that you should be, the presence of the auditor should be represented during the inventory count. But if you were not there, you need to examine how was the process completed then, who conducted it, to what extent is the report reliable, and what could be the consistency in the inventory record. So you do some procedures around that to be able to reach in a consensus whether what you have had as a confirmation of the closing balances are representative of what the actual transactions were. So that is what the standard is trying to corroborate by saying that for you to get a sufficient appropriate evidence regarding the existence and condition of the inventory, you need to have attended a physical count, except where it is impracticable. What are the instances that could make it impracticable? When you have not been appointed as the auditor, it's one of those cases. Other instances could be where the location of the inventory is, for reason beyond control, the auditor cannot get there to making those confirmations. Maybe due to COVID, maybe due to conflict, maybe due to riots or any security exigencies. Then you need to evaluate management instructions and procedures for recording and controlling the results of the entity's physical inventory count. How is the day-to-day management of the inventory and the count also? To what extent is the policies, instructions, and control around the use and issuance of this inventory, to what extent are they as objective as possible? You need to be able to appraise that. But in doing that, you are invariably trying to appraise the internal controls of the organization on the inventory issuance and management. You observe the performance of the management count procedure. You reconcile what is the current balance with the opening year or closing year balances, inspect the inventory count if you are privileged to doing so, then perform the text on counts. Try to look at the arithmetic accuracies on the additions and issuance of inventory. Does it corroborate with the balances affirmed in the inventory record? Then perform audit procedures over the entity's final inventory records. So what will be the exact audit procedure to be performed will be a subject to what are the issues at hand. So that's what we mean by that. So audit procedures for each client depends on the peculiarity and the risks that client processes are exposed to. A volunteer, please. Any volunteer? Yeah, Khadija, you have the floor.
Good evening, sir.
Yeah, good evening.
Okay,
Go ahead, please.
I say 501. If fiscal inventory counting is conducted.
Khadija, you are speaking very far from your mouthpiece.
No, I'm close to it though. What about
Okay,
now?
go ahead. It's better now.
Okay, so if fiscal inventory counting is conducted at a date other than the date of the financial statement, the auditor shall perform audit procedures to obtain audit evidence about whether changes in inventory between the count date and the date of the financial statement are properly recorded. If the auditor is unable to attend physically, 1, due to unforeseen circumstances, make or observe some fiscal counts on an alternative date and perform audit procedures on intervening transactions. 2, if impracticable, perform alternative audit procedures to obtain sufficient appropriate audit evidence regarding the existence and condition of inventory. If not possible, the auditor shall modify the auditor's report.
Yeah, the concept of modification comes up where, first of all, the amount of the assertion given on the inventory are very material. If they are not material, even if you could not represent or you could not attend the counts, you probably may not consider necessary qualifying or modifying the account as the case may be. But we are assuming that you have done your analytical procedure and you've been able, as well as your materiality, you've been able to you've been able to identify striking variance between the opening and the closing periods. You've also been able to ascertain that disclosures made on the inventory are actually very material. You will then have to do all of these that we have identified to be sure that disclosures in the account is a representation of what the true and the fair amount should be. Any question? Any question? Any question? Hello, are we there? Please, can you hear me? Hello? Please confirm if you can hear me.
Yes, sir.
Okay. So I was saying that on this explanation, is there any question?
No, sir.
It appears it's only Khadija that is on ground today. What's happening to others? They've not recovered from the loss of, are they Liverpool fans? The other members, are you?
So we understand.
Okay, that's fine. So let's go on. So you remember that we said on that it's a 501. It speaks to not only specific considerations on inventory, but also on completeness of litigations and claim involving the entity. So let's see, what are the procedures that need to be carried out if you want to confirm whether there are any form of litigations and claim involving the company. Let's see. I need a volunteer. Who is volunteering? Yeah, so Agbaje, you have the floor.
Good evening, sir. Litigations and claims. The auditor shall design and perform audit procedures in order to identify litigation and claims involving the entity, which may give rise to a risk of material misstatements, including inquiry of management and in-house legal counsel, reviewing minutes of meeting between the entity and its external legal counsel, reviewing legal expense accounts. If management refuses to give the auditor permission to communicate with the legal counsel, or the auditor is unable to obtain sufficient appropriate audit evidence, the auditor shall modify the opinion in the auditor's report.
That being said, like we said earlier on, one of the first consideration before you can consider the option of modifying or not modifying an opinion is, does the amount involved or the closing balances actually disclosed? Does it actually meet your materiality threshold? Of course, if it meets your materiality threshold, it then means that any error involved therein could actually affect the opinion that any user of the financial statement could make of it. So for things that, one of the very key things you need to do as part of your audit process is to affirm whether the amount or the caption involved is within your materiality threshold. If it is not within your materiality threshold, you probably may not need to carry out any detailed processes, right? So we are looking at litigations and claim. Litigation means that for one reason or the other, the company is being sued, right? And you know, consequent to this, there could be some contingent liabilities, right? The twin of it is whether the company on itself has sued any entity or individual, contingent to which there could be contingent assets, right? But before this amount or assertions made in respect of these captions are being audited, or before audit procedure are being carried out on this, you must have confirmed, does it meet a materiality threshold? If yes, then you now need to carry out all of these procedures, right? There are also instances whereby there are no even disclosures at all, whether no costs or income has been earned in respect to litigations or claims. But you still need, as part of your audit procedure, to confirm whether there are any ongoing or intended or potential litigation against the company or by the company. So you need to inquire from the management and in-house legal counsel whether they have one. If they don't, if they don't have an in-house person, the management should be able to make a confirmation or refer you to their external legal counsel or the company secretary. So you need to review minutes of meetings between the company and the external legal counsel. In the course of you reviewing the correspondence exchange between these entities, you will be able to know by reason of the communications between the parties whether there are issues of striking attention that the management has to pay attention to, or the issue are what is not really nothing to worry about. And review the legal expense account. How much have they incurred? If there are unnecessarily huge amount that have been incurred for various legal activities, what gave rise to this? Were these expenses incurred in respect of the ongoing litigation against the company or intended claim by the company? It may be necessary that sometimes the external legal counsel might be required to giving you as auditor some level of comfort, right? So you need to put together your the expectations in response to your request for letter of comfort to either affirming to you whether there are cases of material nature that have been litigated against the company or claims by the company. Then finally, if the management refuses to give you as the auditor the permission to communicate with the legal person, then there could be an indicator of certain striking or warning cautions, right? So you then need to review your process and be able to find whether that is actually necessary or not. Whether the need for also considering modifying your opinion because of that or not may be necessary. So all of these are coming out of you having done a diligently conducted KYC on your clients, know your clients, know their procedures, know what their actions may be dovetailing towards when they are obstructing you having access to certain things, right? Without a diligent audit procedure, the opinion reached at the end of the audit exercise may not be fairly represented or representation of what the true substance should be. So we need to be very, very careful. Audit engagement or audit process is not a child's play, and we should not carelessly reach out, make any opinion without having diligently carried out our audit procedure and obtain evidences that are sufficient to back up what our submissions are. The auditor shall request management to provide written representations that all known litigations and claims have been disclosed to the auditor and taken into consideration. So you need also that level of representation from them or their lawyer. The auditor shall obtain sufficient appropriate audit evidence regarding the presentation and disclosures of segment information in accordance with the applicable financial reporting framework. So when you want to do that, by what are the things you need to do? Obtaining an understanding of the methods used in determining the segment information, evaluating whether such methods will result in disclosure and test of applications of such methods, then perform analytical procedures or other audit procedures appropriate for the circumstance. But before we even talk about all of that, what are segment informations? What are segment informations? What are segment informations? Any opinion? What are segment informations? Abdullah, do you want to share any opinion? Abdul Wahab, any opinion?
Sir, please, I want to guess.
Okay, you have the floor.
Okay. I'm thinking segment information is information that relates to certain or specific units or sections, segments of an organization. Information emanating from either department, units, or sections.
Yeah, you are not far from being very
organization.
correct. Information relating to the operations of the company, particularly as relating to its maybe foreign operations, branch operations, regional operations, or certain geographical whatever. So you're trying to be sure that those disclosures made in respect of this information being provided or activities being provided are as accurate as possible. Okay. So instances whereby you are affirming that informations and branches and sales records and various other expenses received from the branch has been adequately accounted for. So you need to be double sure what cautions or step have you taken to be sure that those affirmations or opinion you are giving are a reflection of what the true substance is. So auditing is very sensitive activity and you need to exercise a lot of caution and care in the discharge of your duties. So technically, in summary, ISA 501, as we said, covers basically those specific audit areas that you need to gather or intentionally gather specific audit evidences for. We said it covers existence and condition of inventory, completeness of litigations and claim involving entities, then presentation and disclosures of segment information in accordance with the applicable financial reporting framework. So we need to be sure that what we have put together is actually, and what we are expressing opinion on is actually what the substance is, as opposed to a window dress positions. So we will also share the further details of this standard so that on your own you can peruse it. Don't forget, in a training like this, we probably may not be able to cover all the processes and activities in details, but we will not fail to drawing your attention to giving you a general overview of what the topic of discourse is and drawing your attention to sensitive areas that you are or you can make further findings on. So we'll look at the next one, ISA 510. ISA 510 is on initial audit engagement, opening balances. Initial audit engagement, opening balances. This is where you are actually taking an engagement for the very first time. Maybe the company has never been audited before, or possibly it has been audited before, and you want to affirm that the opening balances that you have in the current period actually is in line with what the closing balances as per the audited accounts, last period audited accounts were. So initial audit engagement is one in which either the financial statements of the prior period were not audited, or the financial statements for the prior period were audited by a predecessor auditor. So that is very clear. It could be that your company has not been audited before. You want to confirm how correct, reasonable, and representative these opening balance were, and where they had been audited before, to what extent are those opening balances a reflection of what the closing balance as reported by the former auditor were. In conducting an internal initial audit engagement, the auditor should obtain sufficient appropriate audit evidence with respect to the following opening balances. One, opening balances contained misstatements that materially affect the correct period's financial statements. 2, appropriate accounting policy reflected in the opening balances have been consistently applied in the current period financial statements, or changes are adequately accounted for, presented, and disclosed. So in doing the audit procedure of opening balances, or before we even get here, maybe we should seek people's opinion. If anybody, is there anybody in the house who works in an audit firm that has carried out an audit procedure on opening balances before? Anyone? Anyone? How many people are working in audit firms? You guys are not speaking out. Nobody? Okay, let's look at what we have put down. To carry out an audit procedure on opening balances, you need to read the most recent financial statements and report thereon, right? Don't forget, you are trying to benchmark the current period opening balances with the last audited account. So for you to have a clarity of what you are expecting the opening balances to reflect in, you must have gone through the last audited accounts, right? Pay attention to all the disclosures and presentations made therein. Then 2, determine whether the prior period's closing balances have been correctly brought forward to the current period, when appropriate, have been restated. So in instances where the auditor has had some closing balances, it is expected that the accountant will have passed the necessary journals to ensuring that his own closing balances of the audited period actually is the same with that of the audited accounts, right? So you need to make those affirmations by comparing likes with likes. Then determine whether the opening balances reflect the application of the appropriate accounting policies. You have to look at the company's policies on depreciation, on assets, on capital, on impairments, on various areas of the coverage of the accounting policy vis-a-vis what they have disclosed in a prior period, whether in the audited account that have been audited or in the unaudited one. You need to be sure that those financials are actually prepared in line with what the standard, the policy actually provides. Where there are areas of discrepancy, you need to spot them out. Say, for example, a company may have had in its policy that their motor vehicle is to be depreciated at the rate of 25% on straight line basis. But meanwhile, when you check the account, you notice that it is 15% depreciation rate they have been applying. So that means there is conflict between the actual accounts, whether audited or otherwise, and what the policy says. So there is need for every organization to consistently apply its accounting policy. The only instances where they are allowed to deviate from what has been provided on ground as the accounting policy is where, in their own opinion, they feel that deviation will encourage or will enhance better and more representative financial reporting. So next one is review the procedure in the predecessor's auditors' work papers to obtaining evidences regarding the opening balances. So you need to understand when you are taking over an audit engagement, that's why you need to be very consistent and complete in your process. Make sure that all your work papers are completed. Because should an audit firm wanting to take over from where you stop, they will make requests for your work paper, and if you don't have it or it's not well or properly done, then you may probably be belittling the value that is expected to have been added to this practice. Evaluate whether litigation could also be taken against the company anyway. Evaluate whether audit procedures performed in the current period provide evidence relevant to the opening balances. So in essence, Opinions are to be gathered. Evidences are to be gathered in respect of varying activities of the company's processes. So I've spoken to the need to consistently apply the accounting policies. You can only change where you felt that that change will give rise to better and a more representative financial reporting. Then I've also spoken to relevant information in the predecessor's auditor's report. You need to understudy to be sure that you have sufficient evidences corroborating what submissions that have been made in those accounts, and it is also consistently adopted by the auditee. Then audit conclusions and reporting. Maybe I should throw this open to a volunteer to read it for us. Thereafter, we explain. Any volunteer?
Good evening, sir.
Yeah, you have the floor. Good evening.
All right. It's 510. Audit conclusions and reporting. Opening balance. If the auditor is unable to obtain sufficient appropriate audit evidence regarding the opening balances, the auditor shall express a qualified opinion or disclaimed an opinion on the financial statement as appropriate. If the auditor concludes that the opening balance containing a misstatement that materially affects the current period's financial statement, and the effect of the misstatement is not appropriately accounted for or not adequately presented or disclosed, the auditor shall express a qualified opinion or an adverse opinion as appropriate.
Okay, yeah. So who can explain what this means to us? Okay, Khadija, you have the floor.
Okay, so for the first paragraph, it just explains that if the auditor is unable to obtain sufficient appropriate audit evidence regarding the opening balance, it can either express a qualified, that if the opening balance is material and not pervasive. Not pervasive meaning it doesn't affect the whole financial statement and the reports and all. That is a qualified opinion that the auditor would a qualified opinion, sir. And if it is material and pervasive, the auditor will report give a disclaimer of opinion on the financial statement. And for the second paragraph, it just has to do with material misstatement, saying if the material misstatement is, of course, material but not pervasive, it's going to be qualified opinion. And if it is material and pervasive, it's going to be adverse opinion.
All right, thank you. Thank you so much. But very importantly, before we could even consider whether we need to qualify or otherwise, you must have confirmed that cumulatively or individually, those balances were within your materiality threshold. Otherwise, it may not, effort requires to investigating all of this may not be very economical, right? So the fact that a prior auditor has been, or a predecessor auditor has audited an account, we don't just jump into the balance, not as though we want to re-audit what the then auditor has done, but we want to obtain a clearer understanding of what informed those balances and how relevant or what audit evidences has been gathered before, and how to what extent has that been reflected in the current year period. So the starting point for your audit process is vet the balances after you must have done your planning and risk assessments proficiently. Then review the balances, that is the opening, before you even look at the current year informations. Make your necessary extractions as evidences, and reach a better conclusion on the performance in the current period and what have you. You will also agree with me that this standard may look so lengthy, that is, this topic actually may look so lengthy and a bit dull, because you just have to do what the standard has provided. You need to know by heart what you need to do on each and every specific instances, and know the procedure to be performed or to be carried out. Also know whether those procedures that you intending to carry out were necessary or not, right? Please, these are very, very important information, and we need to take note of them. So consistency of accounting policies. Accounting policies have to be consistently applied. I've explained that one before. If for any reason this is not, there is need for any deviation, you need to be able to justify the need for that deviation. You need to also put to test whether in arriving at those, the then closing balance, which forms the opening balances in the current period, whether this accounting policy has also been reasonably applied. The modification of the opinion in the predecessor's audit report. I need to stress that the intention, or one of your intentions, or any of your intentions of the current, of any audit, is not to criticize the work of a fellow auditor. Rather, you are to approach your work with a very objective mindset. However, where you see serious deviations that are of relevant and material to the current period, you could then consider, first of all, engage and get sufficient evidences before you put forward the need for that modification. So that's what you need to know as far as ISA 2510 is concerned. We've considered 3 different standards on this topic. We've considered ISA 500, that is on audit evidences, and that speak to us about what actually is an audit evidence, in what forms are they, how do we gather them, what are the series of activities that need to be religiously carried out before we obtain those evidences, how relevant are they, how appropriate are they, then what is the intention for actually gathering these evidences. All of this is as contained in ISA 500. This is just for emphasis sake. You definitely will need to obtain those standards and read them for more information. We also consider ISA 501, which is still on audit evidences, but specifically speaking to specific consideration for selected items. And those selected items were 3. They were in respect of inventory, the other is in respect of litigations and claim, then the third is in respect of segments informations, right? We did consider what are the things you need to do in each of the scenarios, what are the relevant audit procedures that need to be carried out in each of the scenarios, and how will or could this informed or reformed your opinion. Then the last one we consider is ISA 510, which still on audit evidences. You're trying to obtain sufficient evidences that the opening balance in an initial audit engagement is a reflection of what the performance and the disclosures of the company were actually for. So you need to be double sure and obtain sufficient evidences before you make recommendation for modifications of the opening balances where you consider necessary. Then the fourth one today is is a 520, still with the intention of getting appropriate evidences for as audit evidence. But this one is speaking to procedures that need to be done to identify which areas are of better concern or of material or relevant concern, because as auditors, we don't issue an absolute opinion. So we have to prioritize which are the segments of the financials that are of high relevance or high could have been materially misstated. So we pay attention on those areas and maybe little or no attention to the other areas that are less of material misstatements or that are less likely to have been materially misstated. So it's a 520 analytical procedure speaks to this. Analytical procedure means evaluation of financial information through analysis of plausible relationship among both financial and non-financial data. So you are looking at the period under audit and the prior periods. What if you compare likes to like, current sales to prior sales, current cost of sales to prior cost of sales, current asset, the PPE to prior PPE, you may likely get some striking differences or variances. Those differences or variances, whether favorable or otherwise, will then inform what are the specific procedures you need to carry out to actually affirm that those striking differences were not due to any intention to withdrawing, any intention to misrepresenting, and any intention to actually putting forward what is not the actual outlook of the performance and position of the organization. The auditor is to obtain relevant and reliable audit evidence when using substantive procedures and design and perform analytical procedures near to the end of the audit that assist the auditor when forming an overall conclusion as to whether the financial statements are consistent with the auditor's understanding of the entity. So you need to do the necessary analytical procedures to give you a better and informed understanding about the processes and activities of the company and know where to actually pay more attention to. So one of those provision according to the standard is substantive analytical procedure. When designing and performing a substantive analytical procedure, the auditor shall, one, determine the suitability of particular substantive analytical procedure. How relevant is that substantive procedure to the issue and the client at hand? For given assertions, be it sales, assets, liabilities, and every other captions in the accounts, taking account of the assessed risks of material misstatement and tests of details, if any, for these assertions. Evaluate the reliability of data from which the auditor's expectations of recorded amount or ratio is developed. Then take account of sources, comparability, and nature and relevance of information available and controls over preparation. So these are things you need to first of all clear before you can say that the intended substantive procedure you want to perform, it should be applicable to the clients at hand. Then I need a volunteer just to make the class very participatory. Volunteer, please. Any volunteer? Any volunteer?
Okay. Can I?
Yeah, you have the floor.
Okay. Develop an expectation of recorded amounts or ratio and evaluate whether the expectation is sufficiently precise to identify a misstatement that individually or when aggregated with other misstatements may cause the financial statement to be materially misstated, and determine the Determine the amount of any differences of recorded amount from expected value that is acceptable without further investigation as required by paragraph.
Okay, so this is still further speaking to what we have earlier explained before, but in a nutshell, you have to be sure that the threshold for materiality were met, and the needful activity to reaffirm the relevance of those substantive procedures are applicable before you adopt them. So because of time, it's about 7:53 now. We'll note where we are. We want to stop at 5:20. This is a very crucial topic, and we cannot but take our time to judging situations very well before before we just wrap things up. I will take this slide, then maybe from our next class we then start with is at 5:30. But like I said, we will ensure that we share these standards, and you could take time out to reading them, studying them. Where you have need for further clarity, you make it open. If one does not have a keen interest, taking or attending an audit class may be very, very discouraging, because it may sometimes be very boring. Investigating results of analytical procedure. If analytical procedure performed in accordance with ISA identify fluctuations or relationships, that is, increasing or sharp differences or negative relationship that are inconsistent with other relevant information, or that differ from expected values of a significant amount, the auditor shall investigate such difference by inquiring of management and obtaining appropriate audit evidences relevant to management's response, and performing other audit procedure as necessary in each circumstance. So what we are saying is that you are conducting an analytical procedure, you are comparing various captions of the accounts in the prior periods with the current periods, or you are comparing sequence or series of the usual trends in the prior years with the current year, and you saw sharp differences. You are expecting that consistency or that trend to be maintained, but on the contrary, you saw sharp differences. You need to investigate. Say, for example, in our previous year, our sales was 100 million. In the current year, we saw the sales to be 25 million. The question, that is a very sharp difference. So the question will be that, what were the things that happened in the current period that makes the sales to be very, very low? Is it because of the impact of COVID? Were there reduction in the customers' patronage, or what have you? So you need to inquire, even if the difference or the variance is a favorable one, what are the things that have occurred? Because you should be very sure that incomes that are to be deferred have not erroneously been recognized in the current period, hence disclosing huge amounts. So analytical procedure is very, very necessary as part of our various audit process, and it gives us an insight into areas we should pay attention to. It also helps us to identify relevant questions that we need to engage the client on, and by extension, we informed the relevant audit evidences that we need to obtain for future reference. I believe with this, we've been able to open your eyes to certain other areas of audit processes that you need to make further findings on and develop requisite strength and skill in such areas. Any question before we wrap it all up? Any question? Any question? All right, so in the absence of any question, I want to say a big thank you for everyone who has been able to make it for this class today. I hope Our offerings are still very valuable and adding real skill or insight to you. We promise to continue to do this all through this very semester. We are gradually approaching the end of this very semester, but through to the end, we urge you to stay tuned because we still have a lot of other interesting topics to consider, and we can only pray that God will crown all our efforts with good success. Good night, everyone, and hope to see you same time next week.
Good night, sir. Thank you.
Good night.
Good night, sir. Thank you.
Good night.
Thank you very much. Thank you for this class.
Okay, Ezekiel, thank you too.
Ah,
good night.
you're welcome, sir.
How is work and family?
Let's go, sir.
Good to have you around.
Thank you very much. Yeah,
Thank you.